Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin.
Welcome and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. I'm Pam Amato Demagayas, moderator for today's webcast. Before we begin the presentation, I'd like to introduce today's presenters, Jennifer Price and Laura Roos. Jen has been in public accounting since 1999, providing accounting, auditing, and consulting services to a wide variety of not-for-profit organizations. In addition to leading the firm's Oregon practice serving charitable, arts, religious, and educational organizations, she manages audits of colleges and universities, foundations, educational institutions, associations, and other not-for-profits. She also has significant experience conducting audits in accordance with government auditing standards and U.S. Office of Management and Budget Circular OMB A133. Laura has more than 20 years of experience providing accounting and auditing services for not-for-profit clients, specializing in audits of universities, research institutes, arts organizations, foundations, and other not-for-profit organizations. She currently serves as a member of the FASB Not-for-Profit Advisory Committee. So with that said, I'm going to turn the webcast over to Jen to get things started.
Thank you, Pam. Good morning, and thank you for joining us. We're going to start today with a polling question, just to get an idea of who's on the call. What type of not-for-profit organization do you represent? Foundation or grant making, higher education, social service organization, a research institution, trade association, or any other that's not listed on the screen. As a reminder, CPE credit will be awarded based on your participation in these polls. So to participate, please click the button next to the answer that you choose. We'll go ahead and give it a few more seconds. We've still got some answers coming in. Okay, that should be enough time for everybody. We'll go ahead and close the poll and see what the results show. So it looks like we've got fairly good representation from every group across the board. A large portion of higher education and foundations. The other category coming in at 40%, so quite a mix of other types of not-for-profits. Okay, let's get started. What we'd like to talk about today, we'll go over what's new in terms of the industry as a whole. We'll start out with the state of the not-for-profit sector, just some high-level industry data. We'll also go through the FASB's not-for-profit financial statement project. Now that the exposure draft is released, we will go through that in a little bit more detail. We'll also go through recent accounting standard updates, or ASUs, that have been issued since our last webcast in the fall. We'll also go through recent auditing standards updates. And finally, we'll do a reminder on the OMB changes, all of the grant reform guidance that's out there and currently in effect. And then finally, we'll also talk about what's on the horizon, what's upcoming, and any current projects that might be relevant that the standards setters are currently working on. Okay, we'll start with the state of the industry. And this is just some information from the nonprofit sector in brief for 2014. Just some high-level knowledge. Approximately 1.44 million nonprofits were registered with the IRS in 2012. Now this stat is a couple years behind because the IRS reporting takes a little bit of time to get out with extensions of tax returns and such. The 2013 data was not out yet. But this gives you an idea of just how many not-for-profits are out there. And this is an increase of about 9% from 2002. So in that 10-year period, there was about a 9% increase in the number of registered not-for-profits. In 2013, total private giving from individuals, foundations, and businesses totaled just over $300 billion, which is an increase of 4% from 2012 after adjusting for inflation. However, after adjusting for inflation, it's still lower than at pre-recession peak numbers in 2007, which would be $348 billion in 2013 dollars. So the steady growth of the early 2000s did slow between 2007 and 2012. So it will be interesting to see when the 2014 reports come out if it's continuing to come back a bit. On the volunteer front, more than a quarter of adults in the United States volunteered with an organization in 2013. These volunteers contributed over 8 billion hours for that year, representing about $163 billion worth of work. So fairly significant contribution in your volunteers out there. Fewer individuals did volunteer in 2013 than in 2012, however, and those that did spent fewer hours in volunteer time. So it's not exactly increasing from those years. On the foundation front, over 86,000 grant-making foundations were registered in the United States in 2012. And of that, those grants totaled almost $52 billion in 2012, which was up about 3.6 from the 2011 year. And in that last 10-year period of data from 2002 to 2012, foundation grant-making increased just over a third after adjusting for inflation. And the assets represented by these foundations grew from $555 billion to almost just over $700 billion in 2012, which is a pretty large increase at just over 28%. So this is something we thought was interesting, speaking of volunteer hours and how much that translates into today's dollars. This is from the independent sector, and it kind of gives you an idea of what that value of a volunteer hour is worth. This is on average, the volunteer hour is at about $23.07 per hour, so a 52-cent increase from 2013. And it does vary by state, of course. You probably can't see the map really well on the slide, but the darker categories, the dark green states, represent the higher per hour dollars. And so the highest in the U.S. is Washington, D.C., coming in at almost $40 an hour. But in looking at our footprint here on the West Coast, Washington State is the highest on the West Coast at 27.54 per hour, with California coming in next at 26.87. So pretty valuable contributions provided by your volunteers out there. So with that, I'm going to go ahead and turn it over to Laura, and she's going to go through the FASB's Not-for-Profit Financial Statement Project.
Thank you, Jen. All right. In late 2011, the FASB added a project to its agenda to improve financial reporting for not-for-profit organizations. You'll remember the objective of the project is to re-examine the existing standards for financial statement presentations by not-for-profit organizations, focusing on improving the net asset classifications and the information provided in financial statements and the footnotes about liquidity, financial performance, and cash flows. So in our last several accounting and audit updates, we've discussed tentative changes as they had been made by the FASB, and today we're going to go over what's been issued in the exposure draft. As Jen mentioned, that came out in April, and none of these changes are permanent. This is an exposure draft, so it's the FASB's process in distributing information to people or users that would have to apply the standards to get input, and it may or may not be finalized in the future. So the first area is related to net asset classifications. So we currently classify net assets into three classes: unrestricted, temporarily restricted, and permanently restricted. I think we've all got those well memorized and understand them, and we've even trained our readers of the financial statements about them. But I think this is a good proposed change. Under the exposure draft, we would no longer have three classes, but just two classes of net assets. Net assets are either without donor restrictions, or we'd have net assets with donor restrictions. Along with this change, there would be additional disclosures about the amount, purpose, and types of board designations that would be required to be disclosed. In addition, the disclosures related to net assets with donor restrictions would be focused on describing differences in the nature of the restrictions, with an emphasis on both how those net assets need to be used and when the assets or resources can be used. So giving the reader a little bit more information about when those restrictions will expire. The next area related to net assets pertains to the classification of underwater endowments. As you're aware, currently any underwater amounts are included in unrestricted net assets. Under the exposure draft, any underwater amounts would no longer be under the unrestricted, but would be included in net assets with donor restrictions. The exposure draft also requires additional enhanced disclosures related to underwater endowments. The current standards just require us to disclose the underwater amount. The proposed standards will require the disclosure of the aggregate amount of the original gift, the fair value of the assets, and the governing board's policies or decisions to reduce or not spend from the fund when it's underwater. I believe these are good enhancements to the disclosures, and this information should be pretty easily available in order to craft footnotes. The second significant proposed change in the exposure draft relates to the statement of activities. Currently, a not-for-profit organization, other than healthcare entities, they have their own rules related to operating measures, are not required to show an operating measure in the statement of activity. If an organization presents an operating measure, it's self-defined and disclosed in the footnotes, and you can just tell the reader what you're going to include in operations or not in operations, and as long as you do that, you've met the requirements. The proposed standards will require a not-for-profit organization to report an operating measure. And the FASB considered a number of different options before deciding on two concepts, the mission and the availability dimensions. As it relates to mission, the operating measure will include revenue based on whether or not the resources are from or directed at carrying out a not-for-profit's purpose for existence. Then we have to look at the availability measure or dimension. the operating measure will include revenue that's available for current period activities and that reflects both external and internal actions of the governing boards. So this is a different approach than what many organizations use right now. If they're using an operating measure, the exposure draft also defines investing activities unless they're programmatic in nature as investing transactions, so they wouldn't be included in this operating measure. I think the best way to see the impact of this is to look at a financial statement, a sample financial statement. So this is a sample financial statement that's included in the exposure draft. And you'll see there that first section off to the left, the revenue and support. You'll also see these two columns, the first without donor restrictions and with donor restrictions, and then a total. So this first section, revenue and support, would reflect all contributions and revenue received during the year, and then you'd classify it in the statement in the appropriate column, whether it's with or without donor restrictions. And then you'll see there's a total there, the total revenue and support. The next section is very summarized in order to show the other information below, but you'd have your expenses. Generally, we see this functionalized, programs, management in general, fundraising. But just for this example, you'll see a one line for expenses. And then you'll see this first operating measure line, the operating excess before transfers. So this line would represent all revenue and expenses that's legally available or generated to be used in the operations of the current period. And this would include any releases from restrictions. So if you had, you'll see the line up there, releases from restrictions, that would be up in that revenue line. So if you drop down to this next section, right underneath it, it's the transfer sections. And this next section in the financial statements reflects all internal transfers. And so internal transfers are decisions to designate otherwise available amounts as unavailable. So sometimes organizations have a policy where they might take a bequest or a gift of a certain amount and move it to their quasi-endowment fund. That would be an example of an internal transfer. These amounts are required to be included in a discrete section after the first subtotal, but before the overall operating measure. And they'll need to have qualitative labels on the face of the financial statements, or if you used one line item, you'd have to provide additional disclosure in the footnotes to the financial statements. So you'll see there at the bottom of that blue box an operating excess after transfers. So this is that second operating measure. So that's kind of your change in operations. Then you'll see the investment returns. So this, like I mentioned before, these are outside of the operating measure, and it might be very different than what you're currently doing. And this is just based on definition. Underneath this investment section, you'll see other transfers. So there may be amounts being transferred out of the investment income back up to that internal transfer section above. That might be earnings that are allocated on your quasi-endowment fund or other things that should be moved up. Also, we would show down here the bequest example that I just mentioned. It would end up getting moved and being shown down here. So a little different than the way that we're currently doing things. All right. Another area that's going to impact the statement of activities is how gifts for capital-light transactions are handled. So currently, if you receive a building and you keep it and use it in the program, that gift, or not currently, under this new standards, if you receive a gift and use it in your program, so you don't sell it and liquidate it, you'd report the gift at fair value in that contribution line up in operations. Then in the transfer section, the value of the gift would be removed because it's no longer available for current operations. So that's an example of pulling things out of that operating measure when they're not available. On the other hand, if you received cash or stocks or anything related to that to buy a building or build a building, you would report that in the column with the donor restrictions when you receive it. And then once the restrictions met, when the asset's placed in service, you would release the amount from restrictions. So that would increase the column without donor restrictions and decrease the donor restricted, or the net assets with donor restrictions, and with a net effect, and then it would be transferred down and moved below. One other thing that this exposure draft does is it changes the way, or the options that we have for releasing net assets that are restricted for the purchase of a building. Right now we have two options. We can release when we place those assets in service, or we can release them over the estimated life. So that second option will no longer be available to us. So if you're using that method right now, you might want to comment in this process about your thoughts on that and why you use it and why it's an important option to your organization. This, I showed you the first example of a one-statement approach to the financial statements. This is a sample of a two-statement approach. You'll see this first statement here shows the statement of operations, shows that the revenues, then a summarized line for expenses, and comes down to that revenues and support in excess of expenses after transfers. On the next page, if you're using this format, your second page would start off with that revenues and supports in excess of transfers, and then you'll see the additional column for donor restrictions. This is where you'd pull in your non-operating activities and those other transfers to come down to your change in net assets. So a little different approach for financial statements appearance. So two options. We have to have our second polling question. So this question is, which statement approach will be the best fit for your organization? The one-statement approach, the first one that we looked at, or this two-statement approach? Not sure yet, or either would be fine. So you can consider the users of your financial statements, how you're currently preparing your financial statements now. We do often see the columnar format or the pancake format, and so we do have options today. All right. Let's see. So about 50% of us are just not sure yet, and I think that's probably a really good response. I think there's a lot of changes that have been proposed here, and thinking about how those will impact our organization and what still helps us get the most useful information to our readers. All right, let's see. The next area relates to expenses. So our current standards require that only voluntary health and welfare organizations provide a statement of functional expenses. So if you're not that type of organization, you're not required to have a statement of functional expense. It doesn't preclude you from having one. And even the Audit and Accounting Guide a couple of years ago, one of their best practices they mentioned is if you were substantially funded by contributions, and they gave a 20 to 30% range, that it might be a good practice to provide a statement of functional expenses, but not required. But the exposure draft will require all not-for-profit organizations to include information about the natural and functional classification of expenses. And so that's providing the salaries and benefits in some manner, and then how they're allocated to the programs. And this is a pretty good display of that. We have several options. We can include this information in the statement of activities. That might be difficult just based on the type of organization you have, but that's an option. Or it can be in a separate financial statement of a standalone statement, or it can be included in the footnotes, which is another option. You'll notice here too that you can see the different functions, the programs, and supporting activities. And then you'll see this non-operating column. And non-operating expenses, so things that will go below that operating measure, are not required to be functionalized. Another item related to expenses is investment returns and the associated investment expenses. Our current standards allow investment expenses to be shown net against investment returns or as an expense. The exposure draft will require all investment expenses to be netted against investment return in the statement of activities. The exposure draft also defines what investment expenses are. They will be any external expenses and direct internal expenses. For example, if you have an investment department, the salaries and related benefits associated with that department would be netted against investment income. So that might make a little change in your statement of activities. Finally, as it relates to expenses, the exposure draft also includes a requirement for additional disclosures regarding the allocation methods used to allocate costs among program and support functions. So we're currently disclosing the fact that expenses are allocated between these areas, but the method used is not generally provided. The exposure draft has a couple of sample footnotes, and one of them goes on to say we allocate depreciation and occupancy costs, and they're allocated using a square foot basis. So you would include this in your footnotes to the financial statements. Another section in the exposure draft talks quite a bit about and gives some different examples of looking at types of expenses and helping you reevaluate whether or not they're management in general, whether or not they're allocable between different programs. And so it's a really good source to review and think about how you're currently doing things to ensure that, I think over time, sometimes we forget the underlying standards. Let's see. The exposure draft has also proposed some changes to the statement of cash flow. So our current standards provide us an option to prepare a statement of cash flow using either the indirect or the direct method. The exposure draft, though, will require the statement of cash flow to be prepared using the direct method, so we won't have that choice anymore. In addition, the exposure draft changes the definition of cash flows from investing and financing transactions. So they've actually changed what will go in and out of those different categories. So the placement of where items have been previously reported in the statement of cash flows will change. So the thought behind this was really trying to get the statement of cash flow to better align with the statement of activities. And so with the changes that have been proposed on the statement of activities and what's included in operations and not, changes to the statement of cash flows have been redefined. So a financing cash flow will include borrowing cash from lenders and repaying those amounts borrowed, which would include paying interest on borrowed items. So interest payments would be a financing transaction versus operating. Also receiving cash from donors that must be used for long-term investing purposes, and obtaining cash from investors and providing them with a return on that or a return on their investment would also be included in financing. The investing cash flows will include lending cash to third parties and collecting amounts lent, acquiring or disposing of debt instruments, equity instruments, and other investments for the purpose of generating investment income, and collecting interest and dividends on loan, debt, and equity instruments. And so you'll see that's why the investment return is not included in our operating measure. This slide shows the different, where items were classified before and how these definitions have changed where the location would be in the statement of cash flows. So you also see it starts off with, cash received from your revenue sources, whether it's tuition, contributions, and then has your major sources of expenses, whether your payments to vendors, employees, or grants that you're being made. The final area under the exposure draft relates to disclosures around liquidity, and this was something that the FASB really spent some time thinking about. So currently, we're not required to prepare a classified balance sheets like most industries do. We have the option to do unclassified, but we are required to provide enough information to the readers of the financial statements about the ability to convert our assets to cash and the timing of our payables. This is done in a number of different ways. We can sequence the assets according to the nearness of conversion to cash, and the same with our liabilities. We can provide additional disclosures in the footnotes to give the reader that information. But the FASB thought that wasn't quite enough. So this exposure draft includes a couple of different disclosures, quantitative disclosures and qualitative ones. There's an example in the exposure draft of a footnote, and it starts with total amount of financial assets. So that's your really liquid assets. And from there, you would subtract out amounts that are not available to meet cash requirements on a certain time horizon. This is something you'd be defining yourself. For example, you might have external limits or internal limits that would prevent your organization from using some of your cash. Could be a grantor, could be your restrictions, internal restrictions related to your quasi-endowment, all different types of things. So you'd start off with financial assets, subtract out any restrictions that you have, and you'd come down to a subtotal of financial assets available. From that, you'd subtract any liabilities that were due in the same time horizon. And they've talked about 30, 60, 90 days, somewhere in that period of time. And then from there, you'd have a total that would give your net assets available to pay your net assets in excess of your liabilities. So there would also be additional disclosures around how you manage your liquidity. What are you doing internally, or what's your organization doing in order to ensure it's able to pay its bills? So that's the last area of the exposure draft. This is a timeline. They've issued the exposure draft in April. They're doing all types of presentations between now and July. If you're interested in providing a comment letter, the exposure draft has about 22 different questions. You can answer those questions. You can send them an email. You can provide feedback in a variety of different ways. The FASB is very interested in hearing your thoughts and concerns. I've heard them do a number of presentations, and they want to know what you like. And I don't think they really want to know what you don't like, but they're going to listen to it. So I think it's important to give them feedback both ways. There will be 2 roundtables where anyone can attend a meeting and provide feedback in person, one on the East Coast and one on the West Coast. Once all that information is accumulated, the FASB will review the information that's been provided. They can do a couple of things. They can finalize the standard. They could reissue an exposure draft and get more feedback with all the great feedback they're getting from the public, or I guess they could do nothing. I don't think that's quite likely. All right. Our next or final question related to this section is, which section of the recently issued exposure draft do you feel to be the most difficult to implement? Would it be reducing the net asset classifications from 3 to 2? Looking at your statement of activities and determining that operating measure? That would be the financial performance. Would it be preparing a statement of functional expenses or a footnote that shows those expenses? Implementing the direct method of cash flow, or really thinking hard about your organization and how you could disclose the liquidity requirements. All right. It looks like the statement of cash flow is giving a lot of folks concern, and that is understandable. Trying to pull that information together in a different manner could be difficult and take some time, and if it's worth it. All right, Jen, I'm going to turn it back to you to give us an update on the accounting standards.
Thank you, Laura. So next we'll go through new accounting standards that have been issued. We did talk last time about the revenue recognition standard, and I am going to repeat this one just because this is a very robust standard. This came out late last summer, I think August, so it's been out for a while. I'm sure everybody's well aware of it at this point. But it is fairly significant, and this is dealing with revenue from contracts with customers. And there are several different sections of this. And the objective of this was really, again, a single principle-based revenue standard across all industry groups. And really the point of this was to improve the accounting and really provide a more robust framework for recognizing revenue. There needs to be more increased comparability across industries. When you look at all different types of industries, there's different revenue recognition accounting out there. This also requires some additional disclosures that are hopefully better disclosures. So hopefully you've taken a look at this already. There is some time before this is in effect. But a couple of things to consider for not-for-profit entities. This doesn't exclude contributions, so we still have our contribution accounting as we've done before. But it's really important to think about what contracts you have out there. Are grants customer contracts in this standard? And really looking at the definition of what a customer contract is. The impact could be minimal for many not-for-profit entities, but we would encourage you, even if you think it will have minimal impact on your organization, to at least take a look at it. Again, it's very robust and covers a lot of different areas. There are a few items out there as far as guidance. We've put together our own revenue recognition report. We've put the link up there for you. There's also some AICPA resources on it. And here at Moss Adams, we're looking at possibly developing some additional guidance just for not-for-profit entities. So look for that. We may be doing a future webcast or give some more information out for the consideration of this industry group. But just a reminder on the effective dates, it's for annual reporting periods beginning after December 15, 2016 for public entities. So that would be your December 31, 2017 year ends or June 30, 2018 fiscal year ends. Or if you're a private entity, it would be your December 31st, 2018 or June 30, 2019 fiscal year ends. And there is a proposal out there to defer this for one additional year beyond those dates listed. So this may be some time, but again, we would encourage everyone to go ahead and take a look at this. Okay, so moving on to standards that have been issued since our last webcast. We're going to just continue on from the last time we spoke. There's probably 10 or 11 different ones that have been issued since last time. There's quite a bit out there. So we'll go relatively quickly just to give you an idea of what's out there, what's in them, so you can really take note of what may or may not apply to your organization and you might need to look into a little further. So, Accounting Standards Update 2014-16. This one deals with derivatives and hedging and looking at hybrid financial instruments. Some hybrid instruments include an embedded derivative in them. So if you are an investor in these types of instruments, this standard requires some taking a look at, is the share more akin to debt or equity, and really looking at the nature of that instrument. So if you do invest in those types of instruments, you might want to take a look at that one. 14-17 relates to business combinations, and it deals with push-down accounting. And this one really gives you an option to apply push-down accounting when acquiring a business. So this could have an impact. I know we have several clients that do acquire for-profit entities from time to time and purchase businesses and things like that. So this could have an effect. So this is an area to take a look if you do acquire entities or purchase businesses in your practice. 2014-18 also deals with business combinations. This one is related to identifiable intangible assets. However, this one does not apply to not-for-profits. Not-for-profits are exempted from this one, so don't worry about this one. We kept it in here just so it didn't look like we were missing a standard, but that one currently does not apply. Going over to the next page, these are ones that have come out in 2015. So 2015-1, this relates to the income statement and dealing with extraordinary and unusual items and simplifying that presentation. I'm sure everyone recalls the guidance related to trying to determine whether an item was unusual and infrequent in nature. And it wasn't always clear. There was a lot of confusion over what kind of transaction or event would really would really be defined by that. And it was really difficult to determine if your situation was unusual enough or infrequent enough to warrant this special disclosure and be called extraordinary. So this should reduce some complexity, and it basically gives just disclosure guidance related to whether an item is either unusual or infrequent. So it should be a little bit simpler. So if you have any of those situations, you might want to take a look at that. 2015-2, this is consolidation or amendments to consolidation analysis. This may affect limited partnerships and similar legal entities. So it may not have a huge impact in this industry group. However, if you do invest in limited partnerships, you may want to look at that. If you are in a place where you may control them or need to consider consolidation, this could have an effect. 2015-03, this one deals with imputation of interest and simplifying the presentation of debt issuance costs. So this one should have an effect on most of you out there if you have long-term debt, if you have bonds that you've issued, and you have costs associated with that debt. And really the FASB received feedback that having different balance sheet presentations for debt issuance costs compared to debt discounts and premiums was complex and could be simpler. So what this update does, to simplify the presentation of debt issuance costs, the amendments in here require that debt issuance costs related to a recognized liability, a debt, be presented in the balance sheet as a direct deduction from the carrying amount of that debt, so consistent with debt discounts. So instead of reporting it as a separate asset, you would actually show it as a direct deduction from that debt that it's related to. So basically netting it out of that debt. So that's one that you may want to take a look at as you have new debt or additional bond issuance costs going forward. So the next one is 2015-04, compensation, retirement benefits. This one deals with measuring any defined benefit obligations or plan assets that you have. And what this update does, if your fiscal year does not coincide with the month-end information you're receiving about the fair value of your plan assets, this update provides a practical expedient that allows you to measure those assets and obligations using the month-end that is closest to your fiscal year and applying that practical expedient consistently from year to year. So it should provide some simplification for how you are calculating and maintaining those balances if you're getting information that differs from your year end. So that should create a little simpler analysis for folks. So a couple more that have come out in 2015. 1505 relates to intangibles, goodwill, and other internal use software, and it's really dealing with customers accounting for fees paid in a cloud computing arrangement. Currently in the guidance, there is no explicit guidance for accounting for these types of arrangements. So what this does is just provides guidance about fees paid in a cloud computing environment. It includes whether such an arrangement would include a software license or not. If there's no license, you would continue to account for it as a service contract. So if you do have these types of arrangements, you may want to take a look at this one. 1506 is earnings per share. Effects of historical earnings in master limited partnerships. So I think this will be fairly limited for not-for-profits unless you do own a master limited partnership, but this one will probably have minimal impact here. 1507, this one I think will likely probably have the greatest impact for this industry group. This deals with fair value measurements, all of our favorite disclosure item for those of you that have investments. And this deals with the disclosures for certain entities that calculate net asset value per share or its equivalent. And what this does, under the amendments in this update, investments for which fair value is measured at net asset value, or NAV, or its equivalent that use the practical expedient would no longer be categorized in the fair value hierarchy. So removing these investments from that fair value hierarchy is what this would require. Investments that calculate NAV but you don't apply the practical expedient will continue to be included. So this is just removing the requirement for ones where you're using that practical expedient. And you would still continue to disclose information on your investments at NAV as a practical expedient. So the disclosures wouldn't go away for this, just really removing it from the fair value hierarchy. So this will probably affect most of you out there, so you might want to take a look at that one. Update 2015-08, Business Combinations or Pushdown Accounting. This one really just amends some SEC guidance, some SEC wording out there. So this would not apply to not-for-profits. Again, we're just including this in the list so we don't miss any. And then actually there's one more issue I don't have up here on the screen. This just came out in May, so after we went to press with this, there's a ASU 2015-09. And this is disclosures about short duration contracts. It only applies to entities issuing short duration contracts as defined in Topic 944, which is financial services insurance related companies. And so it doesn't apply to the holder of these contracts, so I don't think this will have an effect on any of you out there. Okay. Moving on to the audit front, there is not a lot out there in terms of new auditing standards. We did think it would be a good idea to just talk about two really quickly. We did mention these last time on our fall webcast. However, these are now in effect, so we thought we would just remind everyone about them. This first one is AUC Section 610 or SAS 128, and it deals with using the work of internal auditors. So if any of you out there have an internal audit function and your auditors utilize that function, this would affect your auditors and the procedures they have to perform, so which would in turn affect you and what you provide. And it really just looks at the auditor's requirements and provides assistance to what they need to do when they're under the direction, when your internal auditor is being supervised or directed by the external auditor. It doesn't apply if you don't have an internal audit function, so if you don't worry about this one. And nothing in this standard requires external auditors to use the internal auditor's work. It's just giving guidance if the external auditor determines that that would be relevant and important to use in their audit. So the other audit standard is AUC Section 920 or SAS 129. And this one relates to comfort letters, letters from underwriters and certain other requesting parties. If any of you issue bonds and need a comfort letter or have any sort of public securities offering, this would affect the procedures your auditor performs. And this one's really an amendment to a previous standard, number 122. And it really just addresses the auditor's responsibility when engaged to issue these letters, which are commonly referred to as comfort letters. And so it just amends some of the requirements in that previous standard. I think it allows a little more flexibility in some areas. So if you do issue bonds and need a comfort letter or have anything such as that, your auditors will be taking a look at this and implementing this. Okay. We did want to give you a brief reminder on the Uniform Grant Guidance. And we don't have the time to talk about it in detail today, but because it's pretty significant, we did want to just mention it once again. Hopefully at this point, this is just a reminder and all of you are knee-deep in implementing these changes and getting your policies and procedures updated. So just a quick reminder for those of you that do have federal funds, this is a consolidation of all the previous policies that were out there, your A21, 110, 122s. These are all consolidated now into Title II of the Federal Code of Regulations. They deal with internal controls as well as compliance requirements, and there's also audit requirements that are affected by these. So this is in effect now. Just a reminder, it was effective for new awards issued after December 26, 2014. So any new awards you're receiving today or any amendments or updates to existing awards, if they reference the new guidance, they would be affected by this as well. The audit requirements have another year before they kick in. So it would be your December 31/15 or June 30/16 fiscal years for the new audit requirements to take effect. So hopefully this is a review, and most of you are already dealing with this. The last thing we wanted to cover is really what's coming down the pipeline or what's ahead. We just went through basically what's been issued, even the exposure draft. And so now we're just going to look at a quick high-level look at a couple other active projects that are outstanding that the FASB is looking at. So here are a couple of the items that are currently on the agenda and being discussed. Leases, I'm sure everyone's familiar with that at this point in time. This is one that's been, we've talked about this for several years now, so I don't think it's anything new, but just a reminder that it is still out there. It's still expected to issue. They have made some changes in the last couple rounds of discussions, but it's still expected to issue likely in the next year or so, so watch for this one to come out. Business combinations is a topic currently being looked at by the FASB, and we noted a couple standards that have already come out related to changes in business combinations. And they're taking a look at a couple of items within that. Accounting for goodwill is one that they're looking at, as well as certain intangible assets. So a couple other areas they're looking at in regards to business combinations. Financial instruments is another topic on their agenda. And they're looking at a variety of items in here, disclosures about fair value of financial instruments that are not recorded at fair value on your balance sheet. So for those of you that are required to disclose those financial instruments disclosures for items not at fair value, they're looking at possibly removing this requirement for non-public entities. So that piece may go away for non-publics. So that could be lessening the requirement in some way. And then you might have heard of something called the Simplification Initiative. This encompasses a variety of things the FASB's been looking at. Some of them have been issued as part of this initiative, but they're still looking at some other areas, debt classification being one. And the idea behind these is really to try to simplify things. Some of the disclosures are lengthy and detailed, and I think most of us think it would be a good thing if we could get some of these a bit more simplified. And lastly, they're also looking at a new disclosure framework or making some changes to disclosures. There's various disclosures within this they're looking at. Just to give you a couple, in order to give you an idea what would be included in here. Define contribution plans, looking at changing some of the disclosures for those. Income taxes, looking at different income tax disclosures and the way that those would be presented in the financial statements. Fair value measurements. Again, everyone's favorite. There's a lot out there on fair value and a lot of disclosure. And so it would be nice to see that kind of re-looked at and have some things changed there. And then lastly, inventory is one that they're looking at as well. And as far as looking what requirements are currently out there and do they need to adjust that a bit. Okay, so with that, we're going to do our final polling question. Of the current active projects the FASB is pursuing that we just covered, which one of the following do you feel is most important to your organization or would really provide a benefit? Are you most excited about, if any of them? So leases, business combinations, the financial instruments piece, the simplification initiative, the disclosure framework, or really none of the above? Are you thinking about other areas they should focus on that aren't listed here? So go ahead and indicate what you would like to see there. And we'll just give it a couple more seconds. There's still a couple answers coming in. Okay, let's go ahead and look at the results. Okay, well, I'm not surprised the simplification initiative is the highest on the list there. That's great. I think that will be a great addition as well. Leases also, it's been talked about for so long. It would be nice to see something happen along those lines. And a few of you said something else that's not listed. So kind of a variety across the board here in all the different areas. So with that, we have about 5 minutes left to cover any questions that have come in. I'm going to go ahead and turn it over to Laura, and she's going to take a look at any questions that we've had and see if we can answer any of them. Laura, do we have any questions? Laura, are you there?
Thanks, Jen. Yes, we have a question regarding revenue recognition, or the new revenue standard or proposed revenue standard, and as it relates to can you provide some examples of contracts with customers versus fee-for-service? Jen?
Oh, sure, I can take that one. Okay. Contracts with customers would really be where you're actually entering into a contract with someone to provide goods or services, or you have very explicit deliverables, terms, and situations. General fee-for-service is really just sort of part of what you do day to day. You probably don't have a written contract with an individual end user. It's just something that you charge a fee. Someone can purchase something or obtain a service from you. But if you're actually entering into a contract with terms and deliverables and other requirements, it's probably going to be a contract. And there's pretty good guidance out there as far as what's in the standard in terms of definitions of contracts. So I would encourage you to basically look at that guidance and see if it meets your criteria. But basically you're looking for a true actual contract or agreement between two parties.
Great. And Jen, we have a revenue recognition or standard guidance on our website that can be downloaded too. So you can go to mossadams.com and pull that down. Another question.
There's a great example that walks you through some of those as well.
Perfect. Another question was whether or not MD&A is a dead issue. And the FASB had a project on its agenda, or a research project on its agenda when it started this whole financial statement project. And they had two projects on their agenda. And the MD&A one it was removed from the agenda. And so something will need to change in order to get it back on the agenda. But it's still so not an agenda item. So I'm not quite sure if anything will happen with that.
And we may have time for one more question, Laura. One came in as far as the guidance regarding functional expenses in terms of management versus program. Will there be specific guidance for how you determine whether it's management or program?
Yes, the exposure draft and the current standards have have a lot of guidance and examples. So I always think the examples help solidify what the rules or how the rules should be applied. And so current guidance has it, and the exposure draft includes even more. So it's there. Good. Well, Pam, can we turn it back over to you to close things out for us?
Sure. Thank you again to Jen Price and Laura Roos, and to all of our attendees for participating in today's presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. If you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you should see a download icon in the bottom right-hand corner of the widget window, and you should be able to download a PDF copy of your CPE certificate. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. Also, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Finally, we hope you'll join us for our tax webcast, our tax update webcast, which is next Wednesday, June 3rd at 10 a.m. Please visit our website, mossadams.com/NFP to register. And also on our website, you can learn more about future webcasts, subscribe to our email alerts, and find on-demand versions of some of our previous webcasts. Again, thank you for joining us, and we'll hope you'll join us again next time.